Thanks for clicking. The Toronto real estate market is seeing a major increase in the number of forced sales as the interest rate hikes that we've seen over the past year continue to take their toll, according to a new report from the Toronto Star. The report comes as some are predicting that Canada's real estate correction may not be as bad as many had predicted, as the Bank of Canada is maintaining its pause on interest rates, fixed rate mortgages are down, and a lack of listings is propping up prices.
I think we're going to have a banner year.
But the report from Toronto shows that the future is not so simple, as the pace of forced sales which would not have occurred otherwise, sales which were not present last year, is accelerating. So what I want to do today is go over the report, looking at the increase in the number of forced sales coming out of Toronto, look at why this is happening, take a look at what the big banks have been doing to ease some of the pressure on distressed homeowners, and then discuss what to look for next. Speaking of next, the end of the month is rapidly approaching, and the local real estate board should start to have their data out for the month of March within about a week or a week and a half. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The Star report begins by looking over some of the telltale signs that a listing is a forced sale, including language advising that the buyers treat the property as is, do their diligence, or advising that there will be no inside showings without an offer.
Location.
And all of this language indicates that the property is being sold without the active permission of the homeowner. The property is being sold power of sale. Power of sale, which we've talked about before, does not necessarily mean that the borrowers have defaulted, but rather that the mortgage lender has initiated legal proceedings to sell the property. Power of sale can indeed occur when the borrowers have not made their payments, but can also occur, as we've talked about before, when the mortgage lender won't renew the mortgage and the borrowers are unable to find other financing.
Okay. Why didn't you call me?
Toronto-based realtor Daniel Foch ran an analysis of the number of power of sale listings in Toronto in February and found that there were 35. And although 35 doesn't seem like much, it's a big increase from the 12 that we saw at this point in time last year, and a huge increase from the 0 that we saw in February of 2020. Foch's analysis looked through all of the listings on the Toronto Regional Real Estate Board in February, but he says there are probably even more listings out there, as his search only returned results that had the term power of sale. And the Star spoke to another realtor who conducted a similar analysis but did so Ontario-wide. The realtor in question did not want to have his name published for fear of professional repercussions.
We don't like loose lips.
Indeed, a realtor not wanting to discuss distress in the market for fear of professional repercussions, that probably should have been the headline. And that same headline could also mention that none of this data is available to the public. You have to be a realtor to access it, but I digress. That same unidentified realtor found that there were 105 power of sales in February, 67 in January, and only 24 at this point in time last year. And while 105 sales doesn't seem like much when we look at the aggregate number of sales that go on throughout Ontario, it's a 500% increase from this point in time last year, when the Bank of Canada started to raise rates. After conducting his analysis, Foch said that the majority of the power of sales that he's handled himself were due to investment properties, private mortgages, or second mortgages. Investment properties, obviously that makes sense. If you bought a property in the past year looking to flip it, chances are you lost money. But the reasons for the power of sale, where the private mortgage lender or the second mortgage lender doesn't want to renew the mortgage, is something we've talked about before on this channel, and something I've been seeing more and more as well. Very quickly, say the home buyer purchases the home for $600,000 and puts 25% down. They owe $450,000 on that private mortgage, which is due in a year. Over the past year, London's real estate market has dropped by about $200,000. Let's be generous and say the value of that home only dropped by $100K. That home is now only worth $500,000, but that $450,000 is still owed on it. That LTV, that loan to value, is sitting at 90%. That private lender that is holding the mortgage isn't going to want to keep holding that mortgage, as it's getting more and more risky as values continue to plummet. Traditional lenders, A lenders, even B lenders will only go up to 80% loan to value, so there's not enough money there to switch the mortgage over to a traditional lender, and most private lenders aren't going to take on a new mortgage at 90% loan to value. So that homeowner is basically stuck, and when they can't switch their financing, the current private mortgage lender initiates a power of sale. But it's not just the private side that are seeing these major distresses show up in the system. Numerous reports are coming out showing that banks are extending amortizations for their clients. many of which have seen their payments increase by 50 to 70% since this point in time last year. Recent filings by CIBC show that 1/5 of the bank's mortgage borrowers are not even making enough payments to cover the interest and are actually seeing their loan amounts grow. When the payments made by these homeowners are not enough to cover the interest portion of their variable rate payments, CIBC allows them to tack the difference onto their loan, allows them to negatively amortize.
Just trying to do the right thing.
Not quite. CIBC doesn't want to see a wave of defaults on their books any more than their clients do, but that's a discussion for another time. But the other big banks are also extending their amortizations as well, with 32% of BMO's mortgages having amortizations longer than 30 years, and TD sitting at 29% as well. It's not clear whether or not TD and BMO are allowing clients to tack unpaid interest onto their loan amount in the same manner that CIBC is, and when the Globe and Mail reached out to them to ask, they declined to answer.
Fifth Amendment, old boy.
So, in summary, we have the number of power of sales in Toronto increasing, we have the number of power of sales in Ontario increasing, and we have the banks, CIBC at minimum, allowing clients to negatively amortize, allowing them to not even make the interest payments on their loan and add that difference onto their loan amount. We're not sure about TD and BMO as they are declined to answer. All in all, not great news for the real estate market. The banks are extending amortizations, but that can only go on for so long. They can't kick that can down the road forever. The increase in power of sales in Toronto and Ontario-wide, I'm sure in London, I've seen it in London, are largely due to the increase in interest rates, which don't look like they'll be reversing anytime soon, and to the decrease in values, which, unless something major changes, I don't see the private lenders being okay with continuing to renew their mortgage, continuing to renew underwater properties. With that said, we will continue to track Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.